Welcome to CZNTrades. Today I'm going to walk you through exactly how to start day trading in 2025 as a complete beginner. If you've ever wondered how traders actually make money, what tools you need, and the step-by-step process to get started, this is the video for you. I'm going to break down everything simply, so whether you've never placed a trade before or you've been dabbling in the markets, by the end of this video you'll have a clear roadmap to start day trading the right way. Let's get started. So firstly, you might be thinking, what is day trading? You know, what is day trading incorporated with? How do I day trade? How do I start and everything? So day trading is just the buying and selling of stocks of anything within the same day. So holding for a short period of time, not trying to, hold for a long period of time. It's different from investing long term and swing trading. Investing long term is holding for months to years. Swing trading is investing from days to weeks. The goal of day trading is to capture small and consistent profits by understanding the market movement. So we want to understand how the market moves to create and to obtain, small profits to build a consistent base of profits. Um, it's not about gambling. It's about probabilities, risk management, and discipline. We've got it up here. We've got our three. So I like to break it up in three. We have our discipline. We don't want to be too greedy because greed is what can take, all of our money and end up with none. Risk management, we want to risk about 2% of our account, 1 to 2% of our account for every trade. With this specific risk management, it allows us to, create profit, but also to have room for losses. So say for example, we have an account size of 50 grand, $50,000. We only want to risk that. So we would only want to lose in a situation only 1% of this trade. So when we have our trade set, we have our stop loss around 1 to 2%, and we have our take profits as however much we think. So say the previous high, previous low. So normally we'd want to take profits of around, you know, 5 to 10%, but we only want to risk 1 to 2%. And for probabilities, we really want to have the highest probability of winning. We want to have around a 65 to 80% chance of winning. So once we've broken down, trading to these three categories, it's really simple. You know, the mindset and expectations of traders are 90% of traders fail because they trade it like gambling. They have an obsession with greed. They just want money super quickly. They don't really care about, you know, the development of their brain to, manage a lot of money. Not to endeavor with dodgy trades that you haven't been looking at seriously. This is a business. Think in the terms of, risk, consistency, and profit, like and process. Everything has a process to it. You can't just become rich out of nowhere and create insanely high profits without losing money. So it's like it's a thing that's going to take time. So especially with discipline, it takes time with this. It's not something you can just start tomorrow and become rich overnight. The goal isn't to win every trade. It's to manage risk so you can stay in the game long enough to become profitable. So overall, greed is what ruins a lot of traders. Building and developing the right mindset will fight against this type of greed. And only risking 1 to 2% of the account will allow for you as a trader to, produce as much of a profitable outcome as you can provide for yourself. And having a high probability of winning also minimalizes the chance of losses. So yeah. So now we're going to delve into the tools you need to start. What kind of brokerage you need, what kind of good platform there is to view the charts such as TradingView. I'll show how to read candlesticks and time frames. And yeah, we'll be back. Okay, so now we're on TradingView. So to get started, we're just gonna get started for free. And since we're beginners, we're not looking for any paid amounts yet. We're just starting off slow. So we're gonna go sign up for free. And here we can choose the sign up option. So whichever one you want to sign up with, sign in with that. And let me quickly sign in, I'll be back. So now once you're signed in, might look a bit different to yours, but you just want to head over to products. Once you've headed over to products, you want to, for me, I trade, gold, USD, and these forex pairs. But we're in here now, so I recommend TradingView as a great way to view the charts, only because it's one of the best beginner-friendly platforms. It's pretty easy to understand. It's pretty easy to change. Say if you don't want to see this, you click hide, change the volume. It's pretty simple. You can see heaps of charts and stuff that they offer lots of different pairs, different stocks, everything like that. So now we're gonna explain what a candlestick is, and we're gonna explain, how do I trade, like how do I read time frames, what does this mean and stuff. So let's get straight into that. So in trading, we have green candlesticks and red candlesticks. So let's go. These two right here are a perfect pair. So right now we have a green candlestick and a red candlestick. So these two, one signifies, bearish market, selling, a strong selling price and strength, and we have a green one which equals to a bullish trend, a bullish strength. So this is buying, this is selling. So in the market, we can place a trade on buys or sells. So we can do a short, which means we can place a trade from up here, and with our strategy, means that it's going to go down here, and we take a profit. This is a short. So when you place a short, you're intending for the market to move down. When you place a buy, you're intending for the market to move up. So with trading, we can predict, and we can make our probability good enough to tell us whether we're placing a trade on the downside or the upside. So what a candlestick is a visual bar on a price chart that displays the open, high, low, and close prices for an asset over a specific time period. So up here, we've got our time frames. So say we're in the 1 minute, there'll be much more candlesticks, right? Because we're having every minute a new stick is being formed, whether that's a bullish stick or a bearish stick. So every minute, on this time frame, we're having a lot of bullish and a lot of bearish, right? So that you can just see by the visualization, lots of bearish in the market here. So now we go to the 5 minute time frame. We see a lot of bearish here, and now we see a lot of bullish. So this just shows to us that there's being market movement, right? So this is typically used in technical analysis to interpret market movements and identify potential future trends. So we can see if there's a fair value gap. We can use our confluences to check, whether this is gonna happen, this isn't gonna happen through these candlesticks, right? So let me go into more depth. So let's go to a formed one. So here, perfect. We have a candlestick. We have a wick, which is a little line here, the liquidity line, and we have another wick on the downside. So the green body is the closing price was higher than the opening price. So say it opens here, it closes up here, indicating the buying strength, the bullish strength. The wicks, which are these lines here, indicate that the upper wick here is the highest price this candlestick hit during the market movement. So during this movement, we've had it start from here, we've had it go up, then go up again, then come back down, and it might have come back down here, hit this wick, and come back up, and closed here. So since it's closed, how it's closed, we can see that there's been a little bit of an up in the wick and a little bit of down in the wick, showing liquidity. So what does the candlestick tell me? So what does this tell me? This candlestick can indicate the direction the market's moving, whether it goes up or down due to the color. The size of it can show the price movement. So on the side here, we can see from the bottom of this, it started at 3362, and at the top of it, it closed at 3365. Alright, so these candlesticks can show volatility. So volatility is where, the long wicks. So say we have a long wick like this, for example, this one right here. This long wick can indicate that it's got high volatility and that it could sudden market change could happen. So we can see that there's going to be more dominant price action through liquidity sweeps, such as this wick here. So next, we're going to go into, how do I read this? Like, what's a fair value gap? What's a breaker block? So we have here. So we have fair value gaps. Let me do it bigger. We have order blocks. And we have breaker blocks. These are my three that I use for my confluences. So these are the three that verify me when I'm going to enter a trade. So let's get into what a fair value gap is, what an order block is, and what a breaker block is. Okay, so a fair value gap is a three candlestick pattern. So for example, 1, 2, and 3. So in this fair value gap, so right now we have a fair value gap indicated by these three candlesticks are in the same direction, they're going down. This wick closes here. We have a big wick in the middle. and we have another wick that has an opening here. So we draw in our fair value gap, which is from here to that top wick. We draw it across, and we see liquidity retest. So this liquidity retest indicates to us that the market's respecting the fair value gap, and it's going to show that we're about to have a downtrend. So now if we look at this, see the downtrend, we look at this fair value gap. So this fair value gap shows that there's a rapid movement within the market. So it's creating an inefficient zone. So this is an inefficient zone between buying and selling orders, leaving a price void or gap. So this is a price void or gap, the purple box. The imbalance shows that like it's got a high probability to show. So when the market retests, so when this happens, this liquidity wick, it shows that there's about to be a major downturn, just because we're going on the downside. It shows that there's going to be a major downtrend. So for example, we have a visualization here. There we go. So we have fair value gap, bam, bam, hold, hold, hold. Source of entry is a retest, liquidity wick retest, enter, hold, sell. That's a perfect example of a fair value gap right here. Now, let me quickly find a fair value gap on the uptrend and we'll come back. Here is the other fair value gap on the uptrend. So we can see here the wick here and the wick here. Respects it here. We have an increase. Then comes back down. Respects it here. And we buy here. This is a sort of entry here. Source of entry here. Because we have a break of structure. We buy. And look at this. Just from the fair value gap to a new high. We're creating new highs. We match them with an old highs. Sell that previous high. Right here. Take profits. So we would have just had a massive trade there. Good volume. Would have been a great trade. But that's from the uptrend of the fair value gap. So next, we're going to go into what is a breaker block and what is an order block. So first we'll do what is an order block. So an order block is a specific level, like a specific price level on a financial chart. So for example, we're on the GBP USD, where financial institutions and big traders place a significant buy or sell of orders. So often leads in a significant price change and like in the opposite direction. So these price zones show how big institutions can control the market. So for example, we're on the GBP USD. We have a support and resistance. We have the order block highs, so the sells, and the order block buys. So here. Okay, and we have the previous order block buys here. So in this market, we can see a very, lots of buys, lots of sells, so bearish and bullish market. So we have the start of where institutions buy. So we have their buys, buys, buys. Institutions, big financial institutions hold. This is an order block. They hold, they hold, they hold, they hold, they hold. There's a bunch of sellers here. So the financial institutions sell. Then it comes back here, buys, sell, buy, so on. Until they sell, then they put an order block of buys in here. So it's retesting and respecting the previous lows. An order block of buy comes in. It surpasses the previous high, break of structure, and it tricks the buyers and it tricks the market to start buying. So what they do is sell, an order block sell. So they sell at a new high and go down to the previous low. That's an order block. So once these financial institutions now run the market, they're like, okay, we're going to make more money off this. We're going to buy here. So they're buying more, selling at the previous high, selling. Now a new break of structure, trick the market, sell, hold, buy. Didn't break of structure here. Exactly like the exact same market. Look at this. The wicks are the exact same price, same everything. Order block of purchase. Look, the exact same market movement. Look at this. See how the market moves here, breaks up and comes back and then breaks and starts moving like this. Comes up, breaks up, hits this, comes down, and now it's moving like this. The market is just repeating itself. So the order blocks are from financial institutions, coming to control the market And yeah, so how do you identify this? It's pretty simple. You look for a control candle and you look for a constitutional interest. So they're normally followed by like quick movements and they're normally followed by support and resistance. So you want to look for this. You want to do some market analysis, go through some higher time frames on the 4 hour time frame, and look when is support and resistance used. Why would a financial institution want to do this? So GBP USD, one of the top traded, forex pairs in the market. We can see here that it's moving very well. The market's following itself. It's being ridden by these financial institutions. So next, we're going to go into lastly, what are breaker blocks? Okay, so here we have a breaker block forming. So we'll play it quickly. So here we have a high. Let's draw it in. We have a high here and a low. Keep playing it. And now we have a higher high here, as you can see. And we have a lower low here. So after we have this is a breaker block. So we wait for price to retest back in this lower low. As we can see, price is now retesting in this lower low. And bam. This decrease on the downtrend is indicated. So let's go back to that. So what a breaker block is a high and a low, then a higher high, a lower low, then price moves like this, it consolidates. Then we have a retest in the candlestick. We have it come up, retest. Then this significantly large candlestick indicates that the breaker block is in play and we're on a significant downtrend, which we can see here from here to here. So that just shows, breaker blocks do work as a great confluence and a great way to identify downtrend, especially within the market, as we can see here, high, low, higher high, lower low, breaker block, retest, drop, downtrend, boom, money, bankroll. So that just shows, you know, breaker blocks are used to identify beautiful trade movements and, you know, it's just great. It's a great source of, trading. So we've finished fair value gaps. We finished, on the uptrend, on the bearish and bullish market. We've gone through order blocks, and now we've gone through breaker blocks. And now let's go through, the markets you can trade. Like, you might be asking, what are you even like? What is GBP USD? Like, let's talk about the markets you can trade. And yeah, let's get into that. So here we have the 4 markets you can trade. So we have Forex, which is, two currency pairs against each other. So we have 24 to 5. So 24 different ones to 5 strong ones. So we have, for example, what we're on right now, the GBP USD. So we have the Great British Pound against the USD, the US dollar. We have, AUD USD, so the Australian dollar against the United States dollar. Then we have stocks, which is run by the US market, which is very high filled with volume and liquidity. The market moves excellent via stocks. To trade on stocks, the time frames are much more smaller and tighter, but the market is massive. There's a lot of market fluctuation. And yeah, it's just filled with lots of liquidity. Then we have indices. So indices such as, the Nasdaq 100. We have S&P 500. We have Nasdaq E-mini futures, which is on 24/7. The thing with indices, again, a lot of volume. The volatility is not too high, but then again, there's always things that come into play. The market moves very well, especially with breaker blocks, order blocks, and fair value gaps, and also the use of my strategy that I showed in the previous video. Um, and then we have crypto, which is again very high volatility. The market's open 24/7. With crypto, it's a big market that is lots of financial institutions, lots of, you know, different crypto investors. The market moves, according to news as well. Same with Forex. Same with everything here, to be honest. They all move news based. News can influence these markets a lot. For example, if we head over to anything with USD in it, we can see a significant uptrend. Let's go to it real quick. Well, actually, we'll go to GBP USD. So as we can see here, significant uptrend. Oh, we're just in the replay. That's why I was like, what? A significant uptrend here from the news. So we had a Powell speech, which is the financial, you know, responsibility as a trader. So he talks about, the financial and trade in America. And here, a significant uptrend just from what the words he was saying, talking about the rates and cutting the rates and everything. So again, yeah. So the pros and cons of each. The pros are, you know, everything that I've listed has great liquidity. Markets move very well. But then again, the cons are, news. If you're not checking up with the news day to day, you're not following the news, significant things can happen. For example, we have here durable goods orders. So this could, impact the market significantly. So we just got to keep up with the news. We can use sources such as Forex Factory, which is a great news source for Forex. And yeah, we can just use those to try to build our understanding of the market and how the market's going to move for that day. And then yeah, so now let's go into risk management. Let's talk about, the golden rule, and let's talk about how, stop losses and everything is. So let's get into that right now. Okay, guys, so risk management. So we have the golden rule of risk management, which is protect your capital. So this rule here is, the key rule with risk management. You don't want to lose all your money. You don't want to lose everything you've got. You want to, minimalize the risk of losing everything and maximize the profits. So how we do this is never risk, never risk more than 1 to 2%. So never risk more than 1 to 2% of your account per trade, which is just saying, say for example, you're a beginner, we have $1,000. So never risk more than, so max risk equals, that's just $10 to maybe $20. That's 10 to 1 to 2%. So $10 to $20 per trade. So never risk more than that, because we're trying to protect our capital. So then again, when we're saying never risk more than that, we're saying set stop losses, which is just, for example, we have here, we say we have a sell, we want it to go down. We set our stop loss at a previous high. So we set our stop loss here, and we just, risking only 1 to 2% of the account. So we can set our stop loss there, only risking $10 to $20 over our $1,000 balance, and it drops to here. It's a massive profit. But we're only risking $10 to $20. So if in a bad case, market moves up like this and just goes under our stop loss and comes back down, we're lucky because we have a stop loss set a bit above. So always set it a bit above because liquidity wick can just touch it sometimes and hate a stop loss. Coming from experience, when you have big trades on and you're trying to reduce your capital risk, you want to just make sure your stop losses aren't set too close to the previous highs because obviously it's not going to just copy and paste the previous high. you know, for example, like, let's try to find something real quick. Like here, say the previous high was up here, and it hit this liquidity sweep, little stick. See how the stick? That if your stop loss was set here for this previous high, you wouldn't cook by the liquidity there, the wick there. So just make sure it's always set a little bit above, just so that liquidity wick can't get to you, because that could close out your trade, and you're losing money, you're losing out on profit. And again, a good quote to take under is trading less. Trading is less about money. Less about money. Less about making money. More about not losing it. Which I found very good for me. Because, trading is not, like, it's less about making money. You're not trying to lose your money. Like, as much as you want to make money, it's not going to just happen overnight. So you're trying to minimize your risk as well as maximize your profit. By following this risk management strategy, only 1 to 2% of your account, you should be able to follow, great profit, and everything will just follow your strategy, follow everything. So now let's go into, you know, how to, like, what strategies to use, like how do I start? What do I use for a strategy? So trading strategies you can start off with before you use, the big ones, the big trading strategies such as, support and resistance and everything. Like, not that's not big, but like following, YouTubers and other traders' strategies such as my own. These are strategies you can use to follow and to, begin your trading. So firstly, we have trend following. Can't type. Following. So we're trying to identify, the highs and lows. So that's just the first. So we identify the highs and lows and the higher highs and lows. So straight away, this can tell us a lot, right? So if we just follow the trend, we can look for lots of break of structure. We can look for anything, just from following the highs and lows. So after we follow the highs and lows, we look for support and resistance. So that's just buying near support. So support's the bottom line. I'll show you after this. And selling near resistance. For example of this, let's get rid of this. We're on the 4 hour again for the GBP USD. So I just deleted the middle one. But for example, we have this one here and this one here. So we're buying at the support. So the support's the bottom here. So we're buying here, selling here, buying here, selling here, buying here, selling here, buying here, selling here, buying here. It's probably going to sell here. You're not going to, know the breakout unless you use fair value gaps and you use breaker blocks, order blocks. But then again, you're selling here, buying here, selling here, buying here maybe, or just selling, you're closing a trade, then buying here, probably selling here. But then again, you're making that profit. So this is a perfect example of using support and resistance. Then we have our next strategy, which is breakouts, which is just trading big moves and after consolidation, which is just, trading massive plays. So we have consolidation here and boom. So trading big moves after consolidation. So after the market moves like this, up, down, in the consolidating market, consolidation, 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 buying big moves, boom. Just after consolidation, you buy after a big move. That's what a breakout is. Then we have indicators. So we can, moving averages, RSI. So on this side of here, you can have indicators up here. You have moving average, exponential. You have heaps of other things. So say for example, we have this. It tells us the blue line here. Let me zoom in a bit. On the 5 minute. We have the EMA. So we have the exponential moving average, which is just like how the market's moving. Like with this blue line, we can just see if it breaks above it, breaks below it. Like this is a great indicator, like whether the market's going to move in a bullish or bearish trend. But then again, with all the strategies I've listed here, let me find it real quick. Okay, it's disappeared. All the strategies I've listed here, like they're all useless if you don't have discipline and journaling. So again, journaling is massive in trading. Journaling your greediness. So say, day one of trading, I place a trade, $1,000. I risk $100. So I'm already risking 10% of my account, which is already what I said don't do, and you're already doing that. You know, that's bad discipline straight away. There in your journal should write, day one, bad. Bad trading day, do not repeat this. We're gonna go forward. Let's risk 1 to 2% this time. Practice discipline. Discipline is literally everything in trading. I can't stress that enough. Like, discipline is everything in trading. So yeah, these trading strategies are just, to help you start off before you endeavor into my video, my previous video. They're just to help you understand the market movements and, learn how the market's moving. Because then again, it's just market analysis overall. That's just everything you're doing is just understanding the market, reading how the market moves and learning. Just learning, 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 learning. So now, next, what we're gonna do is go through, demo accounts, how to set up a paper trading account. I showed it in my previous video, but I'm gonna show it again. And yeah, so let's get into that. So, as right now we see, so let's just use a live trade real quick. So this is replay. So right now we can see that we have a fair value gap right here. And now we're waiting for the liquidity retest to indicate an entry for the downtrend. So let's click, where's the button? Let's click replay. Let the market move and bang, retest. So now, sell, get some sells in the market, let's get some sells. heaps of sells. We'll set our stop loss at that liquidity wick. So then again, we're not risking anything here. $20. So I think this account size is 1,000. And let the market play out. And bang. So let's go back. That's too much. Forward. But yeah. So we have a previous low. See this red wick here? Sell at that previous low. That was a profit of, I don't know, didn't see how much the profit was, but yeah, that was a profit. I think it was around $40. So bang, we just made 100% of the account. I don't know how much the account's trading at, but yeah, first trade, boom, just like that, just off a fair value gap. That is, literally just off a fair value gap. So as we can see, is that the fair value gap shows indication and shows the market movement. Retest, downtrend, profit. So now let's go into how to set up a pay per trading account on TradingView. So where we're going to go is trading panel. Super simple. Paper trading. Connect. Currently I have a trade on for some reason. And bang. We're in a paper trading. That's it. That's literally it. That's as simple as it is. You know. So now, for example, we're trading gold. I haven't even, looked at the market. We're just gonna go for something random. So let's just go for a buy. We see the market moving up. Don't do this. I'm just doing it for the video. So we're gonna do 100 units of gold. Let's go. Buy. Send order. Boom. So, oh no, we just click the buy limit. We're meant to buy the market. Buy market, boom, buy. So now we're in. Market executed, we're in a long, which is long is buy, so for it to go up. Buy limit, let's close the buy limit. Okay, so we're gonna set our stop loss, previous low, which is there, which is $500, but we are on the account size of 100K, so that's about less than 0.5% of the account. Is it even? Yeah. So we're gonna set our stop loss there. Realistically, I think we can set it down here, around here. We can set it around down here. But yeah, so we'll just set it down here, and we'll set our take profit at a previous high, just for the video. So bang, just like that. That's how you set it up. That's literally it. So you go, if you want to buy, you do click buy, obviously, because you're going for it to up. And if you want to sell for the sell market, you want it to go down, then you click sell. Pretty self-explanatory. And yeah, that's it. That's how you start your demo account. Then, now you're trading with demo. You want to start looking into how am I going to become a day trader? How am I going to actually use a brokerage? Personally, I would start with funded accounts. I would delve into, we have Blue Guardian, we have what else? FTMO, we have Goated Funded, we have Funded X. These, are prop firms that are trusted. They're very good prop firms that I've been evaluated on and I've passed. And I recommend them very highly to you guys because, they've been the best to me. But yeah, if you're looking to trade live capital straight away, I recommend, Interactive Bro, especially if you're from Australia, Interactive Brokers, CMC Markets, and City Index. They're my top three. I've also heard that forex.com is very good. Oanda is good. And TradeOvat and Black Bull is great. Those are the ones I recommend. Fusion as well. Fusion. Honestly, any of these are great. All the ones with the 4.7, like around 4 stars and above, are perfect in my opinion. But yeah, guys. So that's it with the accounts. It's pretty simple to set up a live account. If it's like it's just setting up anything. Like if you're gonna go set up an Instagram account, it's the same thing as setting up a live account. You got to put in credentials and everything like that. So that's pretty self-explanatory. But it's the same form of trading on here. So you connect it through the broker and you trade just how I showed you in the paper account. It's the exact same thing. And then that's it. That's how you set up your accounts. And yeah, let's go into what the daily routine of a trader is, what I do, when I'm about to trade, what I look at when I'm about to trade. Let's get into that right away. Okay, so when I'm trading, so when I wake up in the morning, I go check the news. So we go check the news, check what, forums are, what's everyone talking about, what news is happening, any speeches on the calendar. So here we can see for Euro at 2:25 a.m. Sydney time, you know, the ECB president is speaking about something economics and financial. Here we have New Zealand retail sales, etc. Like you can read it. It's pretty self-explanatory. But I read for that day what news is happening. So say if I'm trading GBP USD, bank holiday all day. Okay. Say I'm trading here on Tuesday, GBP USD. There's a lot of USD news on Tuesday. So on Tuesday, it's a big, it's a high trading day. It's a risky trading day. Like it's just risky. On Wednesday again, we have some news about USD and GBP. And yeah, so I just check the news. I go onto here, I check the news, I see what's happening. I see, is my forex pair that I'm looking at today going to be breakout? Here we go here. USD and CAD, watch for breakout. So we have conflict, we have indicators what's going to happen for that day. So you check the economic calendars, you you check everything just so you know that you'll be okay. Then what you do, you go to the charts, you mark out the previous highs, you mark out the levels the market's been moving at. So, you've just woken up, say, market high, boom. It respected the previous high, which was here. Literally, it respected it perfectly. And it retested back down. This could happen again where we're seeing, looking previous high, previous low. So marking out our lows in the market. The lows, the lows, the lows. Yeah. Yeah, we're just marking everything out. We're marking our levels. We're looking for areas of interest. And yeah, we're just, starting the day off well, watching the market, analyzing it. And that's about it. The trading session. So when, say, Sydney session, Tokyo session, London session, or New York session opens, we're staying focused. We're not getting distracted. We're not seeing crazy price movement and getting FOMO or anything like that. We don't want to think, oh no, I'm missing out on this trade. I'm not going to find any more profit. I have to get in now. And then it significantly drops and then you lose your money. That's not what you want. You don't want greed. You don't want anything like that. You just want to build your own strategy. You want to focus on yourself. You don't want to focus on anything around you. And then post market, so after I'm finished my trading day, I journal. So you have to write. So what I personally do, I use Notion, which is a great trading journal. And I talk about my trade. I talk about, you know, I took a GBP USD trade today and it was a rush trade, but luckily it profited. You know, Tomorrow I'm not going to look for this rush trade. I'm going to look for a deeper, higher probability of hitting trade. Like you've got to just analyze your mistakes and you got to look at what you can improve. So like by looking at what you can improve and what your mistakes are, it's how you can just keep building as a trader and it's just going to keep making you profitable. So that's about it, guys. That's literally everything. That's everything I know, everything you need to know. That's just the full beginner roadmap to start day trading in 2025. If you want to see the strategies I personally use, join my community, CZNTrades on Discord. It's all free, no paid, nothing. It's just, where I break down my trades in real time. I share my setups and help traders like you stay consistent. Don't forget to like and subscribe and drop a comment if you found this video valuable. Thanks for watching. I appreciate it heaps. I'll hopefully see you guys in the next video. And yeah, guys, thank you so much. Peace out.